In the late 1990s, internet startups with no profits were suddenly valued in the billions of dollars. Revenue became secondary to expectations of future growth. Earnings were frequently ignored in investment decisions. Market analysts promoted new valuation metrics designed for internet companies. One of the most common metrics was website traffic rather than profitability. These traffic numbers were often described as eyeballs. Investors were told that large user bases would eventually produce enormous profits. Between 1995 and 1999, hundreds of internet startups appeared across the United States. Many of these companies had no stable business model. Despite this, venture capital funding increased rapidly. Initial public offerings allowed startups to raise massive amounts of money within months of founding. Technology stock prices rose dramatically during this period. The Nasdaq Composite Index more than quadrupled between 1995 and early 2000. Behind the excitement was a valuation scam built on speculative projections and weak financial fundamentals. Companies that lost money were still rewarded with higher market capitalizations. Traditional financial discipline was temporarily abandoned by large sections of the market. Institutional investors, venture capital firms, and retail traders all participated in the expansion. On paper, the internet economy appeared unstoppable, but the underlying numbers were fragile. When confidence collapsed in 2000, trillions of dollars in market value disappeared. In 1995, the commercial internet began expanding rapidly across the United States. The launch of the Netscape browser made the internet accessible to millions of new users. Netscape Communications went public in August 1995. The company had limited profits at the time of its initial public offering. Despite this, Netscape's stock price doubled on its first trading day. This event signaled to investors that internet companies could command extraordinary valuations. Financial markets began treating the internet as a transformative economic platform. Technology analysts projected that online businesses would dominate global commerce. By the late 1990s, hundreds of startups were being formed around internet ideas. Many of these companies focused on online retail, search engines, and digital advertising. Silicon Valley became the center of this rapid startup expansion. Venture capital firms increased funding for internet-related businesses. Investment banks created specialized teams focused on technology companies. The promise of digital commerce attracted global investor attention. Entrepreneurs realized that internet companies could raise capital quickly. Business plans increasingly focused on capturing market share rather than generating profit. The strategy was often summarized as growth first, profitability later. Startups emphasized website traffic and user registration numbers. These metrics were presented as indicators of future economic power. Traditional financial measures received less attention during this period. Many analysts argued that digital businesses required new valuation models. They claimed that established accounting rules underestimated digital growth potential. Technology conferences promoted the idea of a coming internet revolution. Media coverage reinforced the belief that a new economic era had begun. Magazine covers frequently celebrated young internet founders. Stock market commentary described the internet as a once-in-a-generation opportunity. Retail investors began opening online brokerage accounts. Companies such as E-Trade expanded access to stock trading through the internet. This allowed individuals to participate directly in technology stock purchases. Demand for technology shares began rising sharply. Investment banks responded by preparing more internet companies for public offerings. The supply of technology stocks increased throughout the late 1990s. Each successful IPO reinforced investor confidence in the sector. Companies with limited operating history still received high valuations. Some startups had not yet generated significant revenue. Despite this, investors believed future growth would justify current prices. Analysts produced optimistic forecasts for internet commerce. These projections often assumed rapid global adoption of online services. The combination of venture capital funding and stock market enthusiasm accelerated the cycle. More startups entered the market seeking investment capital. Many founders recognized that valuation expectations were expanding quickly. The incentive structure encouraged companies to prioritize growth narratives. Financial discipline became less visible during the expansion phase. By 1999, technology companies dominated stock market discussions. The Internet was widely described as the foundation of the future economy. But much of the excitement was built on assumptions rather than verified profits. The early success of Internet IPOs created the conditions for widespread valuation inflation. The rise of Internet hype established the foundation for the valuation dynamics that followed. By the late 1990s, Internet companies began entering public markets at an unprecedented rate. Initial public offerings became the primary funding mechanism for technology startups. Investment banks aggressively promoted Internet IPOs to institutional investors. The typical startup could reach public markets within only a few years of formation. Some companies filed IPO documents less than 12 months after launching operations. Traditional profitability requirements were increasingly relaxed during this period. Investment banks focused instead on growth projections and user acquisition rates. The goal was rapid market expansion rather than stable financial performance. Companies promised that future scale would eventually produce profitability. Investors accepted this argument as long as stock prices continued rising. The number of Internet IPOs increased significantly between 1997 and 1999. In 1999 alone, more than 250 technology companies went public in the United States. Many of these companies had never reported a profitable quarter. Despite this, their stock prices frequently surged on the first day of trading. Some IPOs experienced price increases of more than 100% during their debut. This immediate appreciation reinforced investor demand for new offerings. Investment banks benefited from underwriting fees generated by these transactions. Venture capital firms also gained by selling shares during public listings. The IPO process allowed early investors to convert private investments into liquid assets. This created a powerful incentive to accelerate the number of public offerings. Companies began structuring their operations to meet IPO eligibility requirements. Financial statements were often designed to emphasize growth metrics. Marketing campaigns highlighted future market dominance rather than current revenue. Executives frequently discussed user expansion as the primary performance indicator. Investor presentations focused heavily on website traffic statistics. The phrase "first mover advantage" became common in technology marketing. Startups argued that capturing market share early would secure long-term profits. Competition among technology startups intensified during this period. Multiple companies pursued identical business models across online retail and services. Investors continued funding these firms despite the duplication of strategies. Market enthusiasm created the perception that Internet demand was unlimited. Technology analysts issued optimistic research reports supporting these assumptions. Financial media amplified positive narratives about the Internet economy. Retail investors began participating in IPO allocations through brokerage platforms. Online trading made it easier for individuals to purchase newly listed stocks. Demand frequently exceeded the number of shares available during public offerings. This imbalance caused share prices to rise sharply on listing day. Some technology stocks doubled or tripled in value within hours of trading. These gains reinforced the perception that Internet IPOs were low-risk investments. Companies with minimal revenue still achieved billion-dollar market capitalizations. This valuation expansion occurred despite persistent operating losses. Corporate executives recognized that stock market enthusiasm could finance rapid growth. Public equity became the primary resource for funding Internet expansion. The IPO boom accelerated the overall expansion of technology valuations. However, The structure of these offerings depended heavily on investor confidence. If confidence declined, the flow of capital could reverse rapidly. The IPO explosion demonstrated how financial incentives can amplify speculative valuation cycles. During the late 1990s, traditional valuation metrics began losing influence in technology markets. Internet companies often reported minimal revenue and consistent operating losses. Despite these conditions, their market capitalizations continued rising. Analysts introduced alternative performance indicators for evaluating Internet businesses. One of the most common metrics was website traffic. Executives and analysts referred to website visitors as eyeballs. The assumption was that large user bases would eventually produce advertising revenue. This concept shifted attention away from immediate financial performance. Companies began emphasizing growth in registered users. Investor presentations highlighted monthly visitor statistics. Press releases frequently celebrated milestones in website traffic. Financial media repeated these figures as indicators of success. Traditional metrics, such as earnings per share, received less attention. Some analysts argued that Internet companies required entirely new valuation models. They claimed that network effects justified aggressive market valuations. The theory suggested that dominant platforms would control future digital markets. Startups, therefore, prioritized expansion over profitability. Marketing budgets increased significantly to attract users. Many Internet companies offered services below cost to build audience scale. This strategy was often described as customer acquisition investment. Venture capital funding supported these expansion strategies. Public investors continued financing companies through rising stock prices. Executives understood that user growth influenced market perception. Companies invested heavily in advertising campaigns during this period. Super Bowl advertisements for Internet startups became common by 1999. These campaigns aimed to rapidly increase brand recognition. User acquisition costs often exceeded actual revenue per customer. Despite this imbalance, analysts continued promoting traffic growth. Internet portals such as Yahoo and AOL demonstrated that large audiences could generate advertising revenue. Investors believed other startups could replicate this model. Many companies therefore presented traffic growth as their primary achievement. Technology analysts created reports forecasting massive digital advertising markets. These forecasts assumed that Internet usage would expand globally. Investors responded by increasing allocations to technology stocks. Market demand pushed valuations higher across the entire sector. Companies with similar business models competed for the same user base. This competition produced high operating costs and limited profitability. However, market participants focused mainly on user metrics. Financial statements received less scrutiny during the expansion phase. As long as traffic numbers increased, stock prices often followed. Executives became aware that narrative momentum influenced valuations. The emphasis on eyeballs gradually replaced traditional financial discipline. Market participants treated audience growth as evidence of long-term value. However, large user numbers did not guarantee sustainable revenue. This valuation framework created structural vulnerabilities in the technology sector. The replacement of earnings with traffic metrics allowed speculative pricing to expand across the market. Venture capital funding played a central role in the expansion of Internet startups. During the late 1990s, venture capital investment in technology companies increased rapidly. Silicon Valley firms raised billions of dollars dedicated to Internet ventures. These funds were designed to identify and scale high-growth technology businesses. Venture capital firms typically invested during the early stages of startup development. Their objective was to grow companies quickly and eventually exit through public offerings. The initial public offering became the preferred exit strategy for venture investors. When a startup completed an IPO, early investors could sell shares at much higher valuations. This created strong incentives to accelerate company growth before profitability. Startups therefore focused heavily on expansion metrics. User acquisition and website traffic became critical indicators of startup progress. Venture capital partners encouraged aggressive growth strategies. Companies were advised to capture market share before competitors could establish dominance. The logic was that the largest platform would eventually control the market. This belief justified significant spending on marketing and infrastructure. Many startups raised multiple funding rounds within short periods. Each round often valued the company at a higher price than the previous one. These increasing valuations were known as up rounds. Up rounds signaled momentum to other investors and financial institutions. They also reinforced the perception that internet companies were rapidly gaining value. Venture capital firms frequently invested in several companies within the same sector. This diversified their risk across multiple potential winners. However, it also encouraged the creation of many competing startups. Numerous companies pursued similar ideas in online retail, auctions, and media. Competition intensified across the internet startup ecosystem. Many businesses spent heavily to attract users faster than rivals. Burn rates increased as companies attempted to scale operations quickly. The term burn rate referred to how quickly a startup spent its available capital. Companies sometimes spent millions of dollars each month to maintain growth. As long as funding remained available, this strategy appeared sustainable. Venture capitalists expected that public markets would provide future financing. Stock market enthusiasm reinforced this assumption. Rising technology share prices suggested strong investor demand. As a result, venture firms continued funding expansion strategies. Many startups planned their IPO within a few years of founding. Investment banks actively searched for promising internet companies to take public. This partnership between venture capital and Wall Street accelerated startup formation. Entrepreneurs recognized that rapid growth could lead to enormous valuations. The incentive structure rewarded expansion rather than financial discipline. Founders understood that capturing attention was often more valuable than immediate profit. As more capital entered the sector, competition and spending intensified. Some companies expanded faster than their operational models could support. Yet rising valuations masked underlying financial weaknesses. The venture capital system helped amplify optimism across the internet economy. By the end of the decade, venture-backed startups dominated technology headlines. The structure of venture incentives, therefore, played a critical role in expanding the valuation bubble. By the late 1990s, retail investors began entering the technology stock market in large numbers. Online brokerage platforms made stock trading accessible from home computers. Companies such as E-Trade, Ameritrade, and Charles Schwab expanded digital trading services. These platforms allowed individuals to buy and sell stocks without traditional brokers. The cost of trading declined significantly during this period. Lower transaction costs encouraged more frequent participation in financial markets. Retail investors began focusing heavily on technology stocks. Financial news frequently highlighted the rapid rise of internet companies. Television networks such as CNBC expanded coverage of the technology sector. Market commentators discussed internet startups as the future of global commerce. Stock message boards appeared on early internet forums. Retail traders exchanged stock tips and investment theories online. Some of these discussions promoted aggressive buying of internet stocks. The belief that technology shares would continue rising became widespread. Individual investors often purchased stocks based on media coverage and online commentary. Traditional financial analysis received less attention from many retail traders. Short-term price momentum became a major driver of buying decisions. Investors began monitoring daily price movements rather than long-term fundamentals. Technology stocks frequently appeared among the most actively traded securities. Some individuals left traditional employment to trade stocks full-time. Day trading became a widely discussed financial activity by 1999. Specialized trading software allowed individuals to execute rapid transactions. Financial advertisements promoted trading as an opportunity for personal wealth. New investors entered markets hoping to benefit from rising technology valuations. Many retail traders purchased shares in newly listed internet companies. IPO enthusiasm therefore extended beyond institutional investors. Individual traders often purchased shares immediately after public listings. Strong early gains reinforced the belief that technology stocks rarely declined. Market volatility during this period remained relatively limited. Rising stock prices created a feedback loop of optimism among investors. As prices increased, more individuals entered the market seeking similar gains. Investment clubs formed across the United States to discuss technology stocks. These groups frequently pooled resources to purchase internet company shares. Some investors concentrated most of their savings in technology companies. Financial diversification received less attention during the expansion phase. Market participation expanded significantly across retail investors. Online brokerage accounts increased rapidly between 1998 and 2000. Millions of individuals gained direct access to financial markets. Technology sector enthusiasm dominated market sentiment during this period. However, many retail participants had limited experience analyzing corporate fundamentals. This created a population of investors highly sensitive to market sentiment. When prices began falling in 2000, retail investors faced substantial financial losses. The retail investor frenzy demonstrated how public enthusiasm can amplify speculative financial cycles. By early 2000, technology stocks had reached historically high valuations. The Nasdaq Composite Index became the central benchmark for internet companies. Between 1995 and early 2000, the Nasdaq rose more than 400%. Technology companies accounted for a large share of this expansion. Investors viewed the index as a measure of the internet economy. On March 10, 2000, the Nasdaq Composite reached its peak level. The index closed at 5,048 points that day. This represented the highest level in its history at the time. Many internet companies had market capitalizations exceeding several billion dollars. Some of these companies had limited revenue streams. Others continued reporting significant operating losses. Despite this, their stock prices remained elevated. Market analysts frequently justified these valuations using long-term growth projections. Investor demand for technology shares remained extremely strong. Institutional investors increased exposure to the sector. Mutual funds allocated larger portions of portfolios to technology companies. Pension funds also invested in internet stocks through market indexes. Technology stocks became a dominant component of major investment portfolios. The rapid rise of the sector attracted global attention. Foreign investors began allocating capital to United States technology markets. Technology conferences and investor events reached record attendance. Corporate executives described the internet as the foundation of future commerce. Financial media reinforced these optimistic narratives. Newspapers frequently reported record stock market performance. Technology entrepreneurs became widely recognized public figures. Some founders achieved significant personal wealth through stock holdings. Stock options created substantial incentives for company employees. Many workers viewed equity compensation as a path to financial independence. The rising market encouraged companies to issue additional shares. Secondary offerings allowed firms to raise more capital from public investors. Investment banks continued promoting technology companies to clients. Research reports emphasized growth potential rather than financial risk. Market sentiment remained strongly positive during early 2000. However, certain investors began questioning the sustainability of valuations. Some analysts noted the absence of profits across many internet companies. A small number of hedge funds started reducing exposure to technology stocks. Market volatility increased slightly in early March 2000. Technology shares experienced several sharp daily price movements. Despite these fluctuations, optimism remained dominant among many investors. The Nasdaq peak reflected the culmination of several years of speculative expansion. Valuations had risen far beyond traditional financial benchmarks. Large amounts of capital were concentrated in companies with uncertain business models. The stability of these valuations depended heavily on continued investor confidence. Once confidence weakened, the entire structure could decline rapidly. The Nasdaq peak, therefore, represented the highest point of the Internet valuation cycle. After reaching its peak in March 2000, the technology market began showing signs of instability. Several Internet companies started reporting weaker financial results. Revenue growth at some startups failed to meet earlier projections. Investors began examining financial statements more closely. Questions emerged about whether many companies could ever become profitable. Technology stock prices started experiencing larger daily fluctuations. Market volatility increased across the Nasdaq. Some high-profile internet companies announced disappointing earnings. These announcements triggered sharp declines in share prices. Institutional investors began reducing exposure to the technology sector. Large investment funds gradually shifted capital toward more established companies. Hedge funds initiated short positions against certain internet stocks. Market sentiment began shifting from optimism to caution. Financial analysts revised growth projections downward. Research reports started highlighting structural weaknesses in internet business models. Companies with high operating costs faced increasing scrutiny. Investors began focusing again on revenue sustainability. The importance of profitability returned to market discussions. Technology stocks experienced a series of rapid declines during April 2000. The Nasdaq lost hundreds of points within several trading sessions. These losses shocked investors who had grown accustomed to rising prices. Retail traders attempted to buy additional shares during early declines. Some believed the falling prices represented temporary market corrections. However, selling pressure continued increasing. Institutional investors accelerated portfolio rebalancing. Mutual funds reduced holdings in speculative technology companies. This produced additional downward pressure on stock prices. Internet startups dependent on stock financing faced growing risk. Falling share prices limited their ability to raise additional capital. Companies that planned secondary offerings postponed their financing plans. Investment banks became more cautious about promoting new technology IPOs. Market liquidity for internet startups began tightening. Investors demanded stronger financial evidence before purchasing shares. Some venture capital firms delayed plans to take companies public. Technology sector enthusiasm gradually weakened. Media coverage shifted from celebration to concern. Financial commentators began discussing the possibility of a market bubble. Technology founders attempted to reassure investors during public interviews. Corporate executives emphasized long-term growth potential. However, declining stock prices continued undermining confidence. Each major price drop encouraged additional selling. Market psychology shifted toward risk avoidance. The rapid reversal demonstrated how quickly investor sentiment can change. The early stage of the collapse exposed the fragile foundations of the technology valuation system. As stock prices declined during 2000, many internet companies began facing severe financial pressure. Numerous startups depended on continuous access to capital markets. Their operating models required ongoing external funding. When share prices fell, this funding source became unstable. Companies that planned additional stock offerings were forced to cancel them. Without new capital, many startups could not sustain their operations. High operating expenses created immediate financial strain. Marketing budgets had been structured for rapid expansion rather than efficiency. Infrastructure costs for servers, offices, and employees remained high. Revenue growth often failed to match these expenses. Several internet companies began announcing layoffs during mid-2000. Corporate restructuring became common across the sector. Executives attempted to reduce spending to preserve remaining cash. However, some firms had already exhausted large portions of their capital. Companies with weak business models collapsed quickly. One of the earliest failures was Pets.com. The online pet supply retailer had gone public in February 2000. Despite strong brand recognition, the company struggled to generate profit. Its marketing expenses significantly exceeded its revenue. Pets.com shut down operations in November 2000. Other internet retailers soon followed similar paths. Webvan, an online grocery delivery company, expanded rapidly across several cities. The company built expensive warehouse infrastructure to support deliveries. Its operating costs grew faster than customer demand. Webvan filed for bankruptcy in July 2001. Another high-profile failure involved Boo.com, an online fashion retailer. Boo.com had raised over $100 million from investors. The company attempted to build a complex global e-commerce platform. Technical limitations of the time made its website difficult to use. The business shut down only 18 months after launching. Numerous smaller internet startups also disappeared during this period. Bankruptcies spread across technology sectors, including retail, media, and infrastructure. Office buildings that once hosted internet startups became partially vacant. Technology employment declined as layoffs increased. Investors began reassessing the sustainability of many internet business models. Businesses without clear revenue streams failed rapidly. The collapse exposed weaknesses that had been hidden during the expansion phase. Financial markets began distinguishing between viable companies and speculative ventures. Only firms with sustainable business models could continue operating. The failure of many startups demonstrated the risks embedded in the internet valuation boom. The wave of bankruptcies revealed how fragile many dot-com companies had been. As the dot-com collapse accelerated, the financial impact spread beyond failed startups. Large institutional investors experienced significant portfolio losses. Mutual funds that concentrated heavily in technology stocks suffered steep declines. Many retirement funds were indirectly exposed through index investments. The Nasdaq Composite Index continued falling throughout 2000 and 2001. By late 2002, the index had lost nearly 78% of its peak value. This decline erased trillions of dollars in market capitalization. Technology companies that once dominated portfolios lost most of their market value. Some stocks declined by more than 90% from their peak prices. Institutional investors were forced to reassess risk management practices. Portfolio managers reduced exposure to speculative technology companies. Investment committees introduced stricter financial analysis requirements. Many institutions began prioritizing profitability and cash flow. The collapse also affected venture capital firms. Venture-backed startups that had not yet gone public struggled to obtain funding. Several venture capital funds wrote down large portions of their portfolios. Investment banks experienced reduced underwriting revenue. The technology IPO market slowed dramatically after 2000. Few internet startups attempted to enter public markets during the downturn. Wall Street research departments faced criticism for overly optimistic reports. Some analysts had promoted companies with weak financial fundamentals. Regulators began examining potential conflicts of interest in investment research. Financial media also reassessed earlier coverage of internet companies. Market commentators acknowledged that speculation had driven valuations. Institutional investors recognized that narrative momentum had replaced financial discipline. Risk models had underestimated the speed of market reversals. Large asset managers began implementing stronger diversification policies. Technology sector concentration gradually declined within portfolios. However, the financial damage had already spread widely across markets. Employee stock options at many technology companies became worthless. Workers who had relied on equity compensation experienced financial losses. Corporate layoffs expanded as companies reduced operations. Technology industry employment declined across several regions. Office space previously occupied by internet startups became vacant. Commercial real estate markets in technology centers weakened. The broader economy began experiencing the effects of reduced investment. Consumer spending declined among technology sector employees. Some regional economies slowed significantly during the downturn. Investors across multiple sectors became more cautious toward speculative industries. The collapse demonstrated how quickly institutional capital can amplify financial bubbles. When the bubble burst, the losses were distributed across global investment portfolios. The institutional damage reinforced the importance of disciplined valuation frameworks. The dot-com collapse therefore reshaped how institutional financial institutions approached technology investments. Although many internet companies collapsed, several firms survived the dot-com crash. These companies shared certain structural characteristics. Most survivors had sustainable revenue models. They also controlled scalable digital infrastructure. One example was Amazon. Founded in 1994 by Jeff Bezos, Amazon initially focused on online book sales. During the late 1990s, Amazon invested heavily in logistics and technology systems. The company reported losses for several years while expanding operations. However, its revenue growth remained consistent throughout the bubble period. After the crash, Amazon gradually improved operational efficiency. By 2003, the company reported its first annual profit. Another survivor was eBay. Founded in 1995, eBay operated an online auction marketplace. Unlike many startups, eBay generated transaction-based revenue from its users. This model produced consistent cash flow during the market downturn. The company therefore remained financially stable during the crash. Google also emerged during the late stages of the bubble. The company was founded in 1998 by Larry Page and Sergey Brin. Google focused on search technology and digital advertising. Its advertising platform eventually created a scalable revenue system. Companies with clear revenue structures proved more resilient. Businesses dependent solely on speculative growth struggled to survive. Several internet infrastructure companies also endured the downturn. Firms that provided essential services to online networks retained demand. Data hosting and networking companies maintained operational relevance. Investors gradually shifted capital toward these sustainable businesses. Technology markets began distinguishing between infrastructure and speculation. Companies with real revenue streams regained investor confidence. Those without sustainable models disappeared from public markets. The collapse, therefore, created a natural filtering process. Viable technology firms continued operating within the new environment. Speculative ventures were removed from the market. This transition reshaped the structure of the technology industry. The surviving companies became dominant platforms in later decades. Amazon expanded into cloud computing and global e-commerce. eBay maintained its marketplace model across international markets. Google developed the largest digital advertising network in the world. These firms demonstrated that internet businesses could generate durable profits. However, their success relied on operational discipline rather than speculative valuation. The survivors of the dot-com crash therefore represented structurally sound business models. Their resilience illustrated the difference between sustainable innovation and financial speculation. The dot-com collapse revealed structural weaknesses in how markets valued internet companies. Many firms had been priced according to projected growth rather than verified revenue. This created a valuation environment vulnerable to narrative momentum. Market participants accepted assumptions that future profits would justify present losses. As long as stock prices continued rising, these assumptions appeared reasonable. However, the financial foundation of many companies remained fragile. When investor confidence weakened, the valuation structure began collapsing. The collapse demonstrated how speculative narratives can dominate financial markets. During the expansion phase, traffic metrics replaced traditional profitability measures. Website visitors were often treated as substitutes for revenue. This distortion of the evaluation of many internet businesses. Companies that lacked sustainable revenue streams received large valuations. Investment banks, venture capital firms, and retail investors all participated in this process. Each group responded to incentives that encouraged continued expansion. Venture capital firms benefited from rising startup valuations. Investment banks generated underwriting fees from technology IPOs. Retail investors sought rapid gains from rising stock prices. Media coverage amplified the perception of a technological revolution. Analysts frequently promoted optimistic growth projections. These combined incentives reinforced the expansion of technology valuations. The valuation framework therefore became dependent on continued optimism. Once optimism declined, the system reversed rapidly. This pattern is common in speculative financial bubbles. Prices rise faster than underlying economic performance. Narratives replace financial discipline. Capital flows towards companies promising future dominance. Competition increases as new firms attempt to capture market share. Operating costs expand faster than revenue. Eventually, investors begin questioning financial sustainability. Confidence declines and capital flows reverse. Companies dependent on external financing collapse quickly. More stable firms survive the transition. The dot-com bubble therefore followed a recognizable financial cycle. Speculation created rapid expansion in company valuations. Weak business models were temporarily sustained by investor enthusiasm. When that enthusiasm disappeared, financial reality reasserted itself. The collapse removed many speculative companies from the market. Surviving firms continued building the modern internet economy. The event reshaped how investors evaluate technology companies. Financial institutions gradually reintroduced stronger valuation discipline. Profitability, revenue sustainability, and cash flow regained importance. The lesson of the dot-com bubble is structural rather than technological. Narratives can expand faster than revenue. When valuation depends on belief rather than income, markets become unstable. The dot-com crash demonstrated how valuation scams can emerge from collective incentives.